Good afternoon, everyone. My name is Jeff Duguid. Welcome to the Young Member Community of Interest first webinar for 2019. We're joined today by Brent McClure, and the topic of our webinar today is the story your financial statements tell. Brent is not your typical CPA. He is a visionary, a change agent, a paradigm breaker for the business world across multiple verticals. Brent grew up in his family grocery store and took a love of business from an early age and turned it into his future. Brent leverages his extensive experience to help businesses improve profitability, increase their capacity, develop sustainability, and ensure necessary compliance. This provides a gateway to achieving a greater return. Today, Brent is going to give us an overview of how to read financial statements and help us understand what we can learn about a firm through their financial statement. Welcome, Brent, to our SAME Young Member Professional Development webinar. The audience is all yours.
Thank you, Jeff. It's a pleasure being here, and thank you all for having me today. The story from your financial statements. So what we're going to cover today are a few things. We're going to recognize the need to understand financial statements in everyday business. We're going to talk about what makes up the basic financial statements, any appropriate steps to conduct an analysis, and factors that determine how much external financing is needed, as well as how to value a business. Please don't believe everything they say. We hear market analysis. If you watch CNBC or Fox Business or some stations like that talk a lot about what companies are going through or what they're doing, you can learn so much by focusing on their financial statements. Why does this even matter? So we understand that financial statements are a major tool that's often overlooked, and they're essentially the scorecard of a business. And if you can't read the scorecard, then you may be in trouble, or your business may be in trouble, and you not even realize it. Many business owners I come in contact with through my services every day don't understand the story that they can learn from their financial statements. So what are the basic financial statements, and why are they important? We have a balance sheet, an income statement, and a statement of cash flows. Those are the three basic financial statements that everybody looks at or would like to look at. So what is a balance sheet? It's essentially a snapshot of the business at a specific point in time, like as of December 31st, 2018, or maybe as of June 30th, 2019. It also represents the business's assets, liabilities, and equity. Generally speaking, the assets are listed first, or possibly they're on the left-hand side, followed by the liabilities, and then equity or retained earnings. Assets must equal the liabilities plus equity, and of course that's why it's called a balance sheet. So if we look at an income statement, or profit and loss, or P&L, it's called by several names. It's the best tool for knowing if your business is profitable or if you have sustained losses. A P&L statement measures revenue, which is also sometimes called sales or income, and then cost of goods sold or cost of revenue, and then expenses. And this is over a period of time, whether that's a month or a quarter or possibly a year. With it, you know if you've made a profit and how much, or if you've incurred a loss. Our third statement is a statement of cash flows. It's actually my favorite statement. It essentially measures the amount of cash flowing in and out of the business over a period of time. Normally, the statement of cash flows and the P&L or the income statement, whichever you want to call it, are covering the same period. Like it will say on the top of the statement, for the 12 months ended December 31st, 2018, or for the 6 months ended June 30th, 2019, or whatever. It could just say for the period ending December 31st, and you can assume that period is 1 year. The statement generally begins with net income from the P&L, and it's going to end with the current cash balance from the balance sheet. So all three statements need to balance. So far, I've provided you sort of an overview or basic overview of the financial statements. But now I want to take a deeper dive into each one and also provide some real-life examples that you can take away. So first, let's start with a balance sheet. As I mentioned before, it has assets, which are things that you own, like cash, accounts receivable, inventory. Those would all be considered current assets. And the reason they're considered current assets is because you can convert them to cash within a year. And that's a year from the balance sheet date. So if your balance sheet is December 31st, 2018, anything on there that you can turn into cash within 1 year, which would be 2019, that falls under current assets. Property, plant, and equipment, or PPE, on the other hand, is also an asset, but it's a long-term asset, similar to things like notes receivable, other receivables, because they aren't typically converted to cash within 1 year. So if you think about if you had property, plant, and equipment, buildings, furniture, maybe it takes longer than a year to reasonably convert that to cash. Then we have the liability side, which is also made up of current and non-current. Liabilities are things that we owe, like accounts payable, short-term notes payable, line of credit. All are examples of current liabilities because, again, they're due within 1 year. Non-current or long-term liabilities could be things like notes payable or other long-term debt financing. Next, we'll look at the equity section. It's primarily made up of equity contributed to the business plus the balance of retained earnings. So if you think about when you start a business, you're going to put, let's say, $1,000 into the business. That's your opening balance equity. And then every year, your net income rolls into the equity section as retained earnings. And so hopefully the equity section is growing over time as you're earning more money. So let's look at a real life example. So this is Amazon. Hopefully we're all familiar with Amazon, the company. But this is their balance sheet. As of 12/31/2018 compared to 12/31/2017. And we can see they have current assets, cash, short-term investments, net receivables, inventory. They don't have any other current assets at the moment. For total current assets of $75,101. Then they have long-term assets like fixed assets, which I mentioned with property, plant, and equipment. Goodwill goes on your balance sheet when you buy another business, and there's goodwill involved. Intangible assets, it looks like Amazon doesn't have any of those, and then they have some other assets for total assets of $162,648. Now on the other side of the balance sheet, we have liabilities. Again, I mentioned accounts payable and other current liabilities being your current section. You have long-term debt, some other liabilities in the long-term section to get a total liabilities here of $119,099. So lastly, they have their stockholders' equity portion. So they have common stock, they have a capital surplus, retained earnings, treasury stock, other equity. So they have various forms of stock, and you'll see their retained earnings. And again, they have total equity and total liabilities and equity $162,648, which balance to our total assets. Now, if we look at the income statement or P&L, whatever you want to call it, simply put, we have revenues or sales followed by expenses. Now, those expenses can be cost of goods sold, then you have operating expenses, and then any miscellaneous items such as interest expense And finally, or hopefully, you have some profits. Amazon income statement. We're looking at total revenue, $232,887. Cost of revenue, or cost of goods sold, $139,156. Gross profit, $93,731. You'll see at the top it says period ending 12/31/2018. So we assume that period is 1 year. Then in the operating expenses section, we have R&D, sales, general, and administrative of $81,310. So in the sales, general, and administrative, what goes in there would be things like your sales team salaries, benefits, phone bills, light bills, operating leases, administrative costs like copiers, printers, insurance, liability insurance, health insurance, things like that are going to go in sales, general, administrative. So their operating income then turns out to be $12,421. So if we start this page with operating income from the previous page, we're going to be followed by just other, and that is any additional income. Then we have our earnings before interest and tax. Then we have interest. Then we have tax. Coming down to net income from continuing operations, and then finally net income of $10,073. So if you have financial statements for your business, you can hopefully follow them along, just like Amazon has produced their financial statements here. And if a company is publicly traded, you can get access to their financial statements online. Lastly, we have the good part, which is cash flow. Again, this is my favorite one. We'll start with net income, followed by cash flows in and out of the business from operating activities, like changes in accounts receivable, changes in accounts payable, changes in cash from operating activities. Then we have investing activities like purchasing or selling property, plant, and equipment. And then lastly, we have financing activities, which, as you probably guessed, would be things like debt, bonds, movement in stock. So we look at Amazon's statement of cash flows. So up top is for the period ending 12/31/2018, followed by 12/31/2017. So we start with net income, which we finished the income statement with, which is $10,073. Then cash from operating activities, we have depreciation. We're going to add back depreciation because that is a non-cash expense. We have some adjustments. Then changes in operating activities, accounts receivable, changes in inventory, and other operating activities, changes in liabilities. So we have net cash flow from operating. Then if we move on, we have cash flow from investing. Like I mentioned earlier, would be any capital expenditures or purchases of fixed assets or PP&E, property, plant, and equipment. Any investments gives you a net cash flow from investing. Then the last section is financing. So they haven't sold or purchased any stock during this period. Amazon, the company, hasn't. Their net borrowings did go down, so they paid off some debt. And so you get net cash flow from financing, and then you have some foreign currency exchange rate changes. So you get net cash flow of $10,317,000. Make sense? So what do we do with financial statements? Now that we know which ones are important, how to look at them, let's take a dive into several ways of actually analyzing a financial statement. So how much is my business worth? That's what everyone wants to know, it seems like. So this approach, the dividend capitalization model, is an approach that approximates a future dividend stream based on the firm's dividend history and an assumed growth rate, and computes the market capitalization rate that equates it with the current market price. In a closely held firm, like a sole proprietorship, partnership, a private company, they normally don't distribute profits as dividends. So this is estimated from their average free cash flow and compared with the dividends actually paid by a similar size firm. Also, you could call this a dividend growth model. Essentially taking free cash flow and dividing it by your risk-adjusted rate of return less your expected future growth rate will give you the value of your company. Now, this is a rough estimate. There are many different valuation models and experts that value companies. But if you wanted a ballpark answer, this is a way to do it. So let's assume we had free cash flow of $2 million. So in year one, our free cash flow is $2 million. Now, our risk-adjusted rate of return, we want the return to be 10%. We want to make 10% on our money, and our growth rate in perpetuity is going to be 2%. So we're going to grow 2% a year for every year in the future. So if we take $2 million and divide that by 10% minus 2%, we're going to divide it by 8%. Then our business value would be $25 million. So if we have a $2 million business that's going to grow at 2% and our risk-adjusted rate of return is 10%, that business is worth $25 million today. So that is an easy way to get the value of a business. If we look at other ways to value businesses or financial statements, let's talk about ratios. We have two major classes of ratios, cause and effect. Effect ratios measure the results of company actions, not necessarily their cause, things like liquidity, leverage, and profitability. Causal ratios measure the actions or lack of actions that cause the effects. A ratio by itself, if we think about it, is almost meaningless. What if I told you that I had a business and the current ratio was 2 to 1? That doesn't mean very much to you. But if we have another company to benchmark that from, or maybe an industry average to compare our business ratios, then it starts to paint a pretty cool picture. Liquidity measures are going to show our ability of the business to meet short-term obligations as they come due. Liquidity ratios are things like the current ratio, the quick ratio, defensive interval, so on and so forth. Receivables over working capital, operating cash flow to current liabilities, and a few others. A look at liquidity ratios again and what category they're measuring, for example. Current ratio and the quick ratio are going to measure the quantity of liquidity. Liquidity means cash. The defensive interval and cash conversion cycle will look at the timing of liquidity. Inventory over working capital, receivable to working capital are looking at the quality of liquidity. What level of quality do you have in your cash? And some early warning ratios, early warning signs would be net sales to net worth and operating cash flow to current liabilities. So if we dig in a little bit to some of these ratios specifically, the current ratio is actually one of my favorites. Specifically, is current assets over current liabilities. It measures the quantity of liquidity, like I mentioned earlier, and its size is largely determined by inventory. So if you think about current assets over current liabilities, and we learned earlier today that current assets are things like cash, accounts receivable, inventory, prepaid expenses, and you're going to divide that by current liabilities, which are going to be things like accounts payable, accrued liabilities, maybe vacation payable, payroll liabilities, things like that. You're going to get a ratio, which again doesn't mean a lot by itself, but if you can benchmark it to industry averages or other companies in your space, then it starts to paint a nice picture for you. The quick ratio is another cool ratio. It is simply the current ratio without inventory. It's one of my favorites as well. So it's cash, marketable securities, receivables, current assets minus inventory divided by current liabilities. So if we look at a defensive interval, we can take quick assets, which are going to be cash, marketable securities, things that you can quickly convert to cash, divide that number by daily cash operating expenses, then this measures the number of days the firm's cash basically will last if no new sales occur. So think about it. It's when are you going to completely run out of money? So if you have $1 million in the bank and $1 million worth of accounts receivable, so your top number is $2 million and your daily operating cash expenses is whatever, then you'll know how many days you have left that you can stay in business with no new sales. So let's look at an example of inventory to working capital. So we're looking at the quality of our liquidity. So in company A here on the screen, we have cash of $2,000, AR or accounts receivable of $16,000, inventory of $10,000, for total assets of $28,000. Our liabilities are $10,000, so our working capital is $18,000. So our inventory to working capital would be $10,000 over $18,000 would be 56%. So 56% by itself doesn't mean a whole lot, but if we're looking at an industry average of 60%, then we're doing pretty good. Whereas we take company B, they actually have a lot more assets. They have $110,000 worth of assets and $30,000 worth of working capital. So it sounds like they're doing much better, but their inventory to working capital would be 60,000 over 30,000, right? Because their inventory is at 60,000. That's 200%. So their quality of liquidity is actually much lower quality because they have much of their asset value is tied up in inventory. So they're at 200% versus the industry average of 60%. So we can see how these measures make it pretty easy if you have an industry average, which you can Google industry average and get these numbers readily available for your company. But it makes it pretty easy to benchmark yourself against an industry average, and then you know maybe what you need to do. Trade receivables to working capital. Again, this also measures quality of liquidity. So if we look at our cash, trade receivables, which is just like accounts receivable or AR, inventory, then we have liability, current liabilities, gives us working capital of $10,000. So in our first company, company H, our trade receivables working capital is 60%. Industry average is 75%. So we're close. Not really there yet, but we're close. But if you look at company J, they actually have a lot more they have 3 times the working capital, and their total current assets, are $85,000. So they have much more working capital and more assets. So you think they're in better shape, but really they're not, because their trade receivables are $50,000. And so that's 166.7% when the industry average is 75%. So company H is much more in line with the industry average. Again, if you look at net sales to working capital as an example compared to your industry average, we're looking at the ability of working capital to support sales, which then supports growth. So here in company V, our sales are $150,000. Actually, in both companies, they're $150,000. In the first company, we only have $1,000 of working capital, so that sales to working capital number is 150 times, and the industry average is 10. Where in the second company, we have much more working capital because we have less liabilities, and we're right on top of the industry average. So if we're moving on, leverage measures, we're looking at the ability of a firm to meet obligations as they come due. And some of these ratios are like debt to net worth, debt to assets, times interest earned, etc. Profitability measures are showing the ability of a business to earn a return, like return on equity, net income over net worth, and a few others. So let's take one for example, net profit to net worth. So we have $2 million for each one of our companies. The net profit on the first company is $20,000 over a net worth of $80,000. Our net profit to sales is only 1%. The industry average is 3.3. Our net profit to net worth or return on equity is 25%, and the industry average is 8.8. Whereas in our second company, we'll see our net profit's 5%, so we're over the industry average, and our return on equity is only 10%. We're a little bit closer to the industry average. So if you benchmark your company against your industry average, you can see which way you need to go. So let's think about this problem. Suppose that a company's current ratio was 2.5 last year and decreased to 2 this year. Last year's quick ratio was 1 and stayed constant. So if you think about what I've mentioned so far, something changed between the current ratio and the quick ratio, and the difference between those two ratios is inventory. So the ratio of inventory to current liabilities must have decreased from 1.5 to 1. So if you're watching your ratios, you can see it from this example that likely there's been an inventory decrease this year. And I feel like you all like questions, so let's tackle this other problem. If a company has a debt ratio of 40%, what is its debt to equity ratio? So I'm thinking, at first glance, if it has a debt ratio of 40%, then its debt to equity ratio would be 60%. But I know you all are better at math than I am, so let's see what the real answer is. Debt to assets would be 40% and our equity to assets would be 60%, so our debt to equity actually is 66.7%. And this just shows that the two ratios measure the exact same thing, they're just using a different scale of measurement. So let's talk about our effect ratios and kind of summarize these. So current ratio, if it's small, you don't have adequate liquidity. Same thing for the quick ratio. If the defensive interval is small, it implies the company can't survive very long without new sales, so it may lead to a crisis. Inventory to working capital, if it's large, it indicates poor quality of liquidity because you have much of your working capital tied up in inventory. Receivables to working capital indicates, if it's large, it would indicate a poor quality of liquidity. Inadequate liquidity to support sales if your net sales or working capital is large. Debt to net worth, if it's large, it indicates increased financial risk. Debt to assets, same. Tangible debt ratio measures debt usage proportionate to tangible assets. Short-term debt to net worth, if that's large, then you have a high risk situation. Times interest earned, that is how many times your profit covers your interest, and if that's small, then you have insufficient financial solvency. Fixed charge coverage ratio, many times you'll see times interest earned and fixed charge coverage in debt covenants, like if you borrow money from the bank, they're going to have those two ratios you have to measure. And fixed charge coverage measures how many times earnings will cover your financial obligations. And then we all probably know by now what return on equity is. So if we're looking at earnings quality, if the company can continue to earn at the same rate, then we tend to have a strong earnings quality, and vice versa for a weak one. So if we have the perceived ability to continue in business, we're looking at the strength of the balance sheet, maybe some one-time transactions, like we expanded into a new building this year, so that would be a one-time transaction. What are the ages of the assets? Are we doing proper R&D if that boosts our business? The age and the incentive packages of key managers. That all factors into earnings quality of a business. Causal ratios. Fixed asset to net worth, collection period, net sales to inventory, net sales and net worth, all measure different things from the balance sheet. Fixed asset to net worth, for example, measures the extent to which capital is tied up in non-liquid, permanent, or depreciable property. And it also gives us the amount of capital remaining for investment in more liquid assets. If too much net worth is tied up in fixed assets, then we don't have enough working capital. We've probably overutilized our debt, and that tends to make our profitability suffer. So you think, how does fixed assets really affect profit? So we have interest expense because generally we borrow money for fixed assets. Our depreciation is going up. We have higher property taxes and insurance costs. We used working capital to buy them. We could have inventory stockouts because we can't supply adequate inventory. Our bank balances are much lower. If we look at a collection period, measures basically the credit and collection efficiency of the business, profitability of bad debt write-off, and the company's receivable position over time. And you can compare that to your industry. So if this ratio is too high, it indicates inefficiency or a decision to allow loose credit terms. So if your collection period starts to grow, then you need to look under the hood of the business a little closer to see what's going on. So why does this ratio matter? So sales attainment, profitability, borrowing, all that comes into play for the collection period. So if we think about a summary of our causal ratios, so we have reduced liquidity, increased leverage, and reduced profits are caused by, and we can look at our causal ratios to see that large fixed assets over net worth, we have a larger than average collection period, a low inventory turnover, large net assets to net worth, lower negative profit margin, large miscellaneous assets to net worth. Those can all cause problems like reduced liquidity or increased leverage, or lastly, reduced profits. So given what you know now, let's talk about conducting a financial statement analysis, the moment we've all been waiting on. So industry analysis with industry averages or comparison to competitors is one way to do it. I've mentioned that several times, but you can get your balance sheet, your income statement, your statement of cash flows. You can run all the ratios that we've talked about. You don't necessarily have to run them all, but you can pick 5 or 10 ratios that you think are key. Run those each time you produce financial statements. Let's say you see financial statements on a monthly basis, then you want to run your ratios on a monthly basis. You can trend them over time from current year to past year, current month, past month. You can compare them to your competitors. They help you determine exactly what problems exist. You can compare your ratios to previous years, your causal ratios. You can determine which one are at fault, and that allows you to take corrective action. Some guidelines that I like to use: ignore isolated figures, compare likes with other likes, study any substantial deviation, try not to get hung up on high percentages or variances. Remember that a ratio measures both sides of the component. So you look at the top and the bottom of your ratio and recognize the seasonal factor. Like I was talking about, if you're measuring ratios on a monthly basis, then if your firm or business is slow in the summer, your ratios are going to go up or down depending on which ratio it is during the summer, and maybe flatten out during the fall and spring or winter months. So you need to be alert for the seasonal factor. You can certainly watch for trends if you're watching your ratios, and let's say your current ratio that you're watching, which is current assets over current liabilities, starts going up or down, then be alert for that, and then look at what is driving that ratio to go up or down. If you think about your average CPA, they can probably look at comparative financial statements and tell you what is driving issues with cash or inventory or whatever the case may be without doing a ratio analysis. But for non-CPAs, a ratio analysis helps you understand what is driving differences in your financial statements, and then you can compare to industry averages to help streamline your business to be as profitable as possible. If you go into the bank to borrow money or go into a lender, or asset-based lender to borrow money, they're going to be very balance sheet focused. They're going to want to know current assets, current liabilities. They're going to look at current ratios and quick ratios. Whereas owners of companies and managers are more income statement driven. They want to see profit. and how profitable the company is or how profitable the business is doing. That's what they're focused on. So how can we forecast sustainable growth? And some people ask me, can you grow too fast? And actually you can, because you can grow so fast that you run out of resources or run out of money, especially if you have financing terms and you're not collecting as fast as it takes to build. So if you're a professional services organization and you have a huge influx of orders or work and not enough people to produce the work, then you're growing too fast because you're running out of resources. But first, before we can get into that, let's talk about what a spontaneous asset is. Spontaneous assets are ones that move a little more often when a sale happens, and that's cash, receivables, and sometimes inventory. Quasi-spontaneous would be fixed assets, and things that aren't really hinging on the sale of a product would be marketable securities, prepaid expenses, investments, and intangible assets. Now, on the flip side, if we think about liabilities, accounts payable, accruals, taxes payable, those are moving when we have a sale of our service or product. Retained earnings is moving also. Things that don't move as much when we sell our services will be notes payable, long-term debt, bonds, our stock. That's not necessarily moving when we have a sale. And I had to tell you about spontaneous assets and spontaneous liabilities so I could show you this awesome formula. So this is an external funding need formula. So what we're looking at is essentially our change in sales with our change in fixed assets, our spontaneous liabilities, again, times our change in sales, change in retained earnings, plus any other thing that we left out. So if we look at this formula a different way, we have funds needed, because if we're growing, our spontaneous assets are going up. So we have spontaneous assets over sales times change in sales plus change in fixed assets. We need funds to do that. Now we're generating funds internally with the formula spontaneous liabilities over sales times change in sales minus any changes in retained earnings with any other miscellaneous things. So if you plug this in, it will show you your estimated funding need. And we have to talk about assumptions. We're going to make a lot of assumptions, especially in that formula. And so the model does assume that future sales levels are very important of the future financial condition, and financial relationships of many balance sheet items and sales remain the same. We can change assumptions as necessary and useful in the model, and you want to test the importance of your assumptions or changes in assumptions, and that's basically called your sensitivity analysis. And so if you look back at the formula, we have the definitions here of what those are: spontaneous assets and spontaneous liabilities, change in sales, your change in fixed assets required to meet increased demand, spontaneous liabilities with your existing sales level, and then your change in retained earnings. So if you plug this in, you're going to get your external funding need, or how much money do you need at this level of growth. Does that make sense? So your funding need comes from funds needed minus internally generated funds. So the business itself will generate some funds, and your funds needed may outweigh your internally generated funds, which essentially would be your external funding need. We've already talked about assumptions. So your methods of external funding need, you can get that from some external sources, like you can borrow debt, you can get bank loans, you can go for bonds. The owners or officers of the company can issue loans. You could sell stock in the form of equity to existing stockholders. You could sell stock to new stockholders. Internal sources would come from decreased payout. So if you're paying out less to the owners in the way of dividends, maybe you're making a higher profit margin, that would increase your internal sources of funds. Your working capital has improved, less usage of fixed assets. These are different ways. So if you think about the ratios we talked about earlier, if you can get those in line with the industry average, like payouts and profit margins, and then so you can tweak your business to where it is running seamlessly, hopefully seamlessly, and in line with industry averages, then you can hopefully drive down your external sources needed. But assuming there is an external source left or external funding need, you can certainly go to the bank, to friends and family, to outside shareholders. There are a few areas you can go. So with that, let's wrap this party up. So what have we covered? We talked about the need to understand financial statements in everyday business. We talked about the basic financial statements being a balance sheet and income statement or P&L. And we talked about the statement of cash flows or a cash flow statement. Now we understand that those are the three major statements. We know that banks and lenders are focused on balance sheets. Most owners and business operators and managers are focused on the P&L or income statement. I have a client right now, they haven't produced a balance sheet in years. They don't really have any outstanding debt, and the owner of the business is only focused on the income statement, so that's all they produce are income statements for the owner. He could care less what's on the balance sheet. We have talked about ratios, probably more ratios than you knew existed, but we've talked about different types of ratios, the causal ratios and the effect ratios. We talked about how to run your financial statements through a ratio analysis, and then we talked about how to compare that to industry averages. And one bullet point I don't have in here, we talked about how to get the value of a business, how you can value a business just using future cash flow coupled with the risk-free rate of return minus your growth rate. And then lastly, we just looked at external financing needed and how you can calculate how much external financing is needed as your business grows. So hopefully you all are able to walk away with at least one or two items from here. And I know I covered a lot in a short amount of time. So I think these slides, you had a link where these slides are available. And with that, I will wrap this up and hand it back over to Jeff.
Thank you, Brent. This is actually Matt Turner.
Hey, Matt.
And I did have one question.
Yeah.
You're talking about, just general awareness of fluctuations from any given time period as you're kind of evaluating those ratios.
Yeah.
Do you have a recommended guideline on how often you actually do some of that deep diving? Is it a quarter? Is it biannual?
I would recommend at least a quarterly look, because you're going to have some seasonality across the quarters, or probably there's going to be some seasonality across the quarters. Looking at the ratios every month, I certainly recommend, but taking a deep dive behind the ratio and looking at, okay, what's driving my current ratio just moved 2 points, what's driving that, and taking a deeper dive into the actual reason it's moving. I would say at least do that on a quarterly basis.
Okay. Now, I don't know if anybody else in the audience had a question for Brent. Another one I had for you, Brent, is when you were talking about company evaluation. You kind of showed an example of the dividend capitalization model.
Uh-huh.
Is that one you see with professional services? I was kind of curious on how much inventory came into play there. I think a lot of the folks on the line are, with the AEC community, primarily professional service driven with not much inventory. So I didn't know if that factored in to that particular model.
It doesn't. Inventory doesn't factor into that model that much at all. It actually works well for a professional services organization or an engineering firm or a CPA firm or professional services firm in general. That model actually works pretty well for a firm or an engineering firm because it's based on cash flow, not necessarily the balance sheet. It's based on the future cash flow of the business. And so, in essence, to a buyer, the buyer is buying the future cash flow, and you're looking at how much is that cash flow worth today. And so you need the risk-free rate of return, which I threw out an example, I think, of 10% minus your future growth rate, which I had my example of 2%. So I'm saying we may grow 5% next year and 10% the year after that, but then a few years down the road, we're not going to grow that much. So let's just call it 2% on average. And so the value of that firm, in my example, I think was like $25 million. So that's what you could sell a $2 million cash flow for.
Okay.
Yeah. Another way to look at firms would be just a multiple on EBITDA, earnings before interest, taxes, depreciation, and amortization. Mm-hmm. If you know the industry average, and that's what we hear in the markets when you're talking about they're trading on a PE, price to earnings value of 10 or 15 or 17 or 50, like Amazon. That's what we hear. Most privately held businesses that are smaller, let's say less than $200 million in revenue, they're going to be in the single digits. And so what you do is you get your earnings before interest, taxes, depreciation, and amortization from your income statement. And then you multiply that times your number. So if your EBITDA is $2 million and I'm not sure what engineering firms would be, but I'm working with a manufacturing company right now, and their spend is about 7x. And so if they were doing $2 million, you just multiply that times 7, you get $14 million. That's what it would be worth.
All right. And then the whole missing component there, which I guess comes into the negotiation, depending on what you're dealing with, is how much of that is coming from relationship based on the partners and the ownership group for the likelihood of that forecast.
Yeah, absolutely. And that's one of the things I pointed out was the incentive packages and the ages of your managers, and that includes owners as well. Like if you have retiring partners from an engineering firm and they have all the relationships and they haven't shared any relationships, then you're going to devalue the price of that firm a little bit because you're afraid some of those relationships are going to not stay as strong or walk away once it changes hands.
Yep.
Yeah.
Well, excellent. Anyone else have a question for Brent?
Crickets. We're all perfectly right in line with you, Brent.
It sounds like it. I'm not sure.
Oh, if there aren't any other questions, going, gone.
Well, actually,
thank you very much, Brent. Oh, go ahead.
Never mind. I thought we had one in the chat board, but that was you.
Yes.
Got my hopes up.
Sorry. Well, good thing Matt's here. He had some good questions for you. Thank you very much, Brent, for coming out and speaking to us. We thoroughly appreciate it. Want to remind everybody that's on the call, thank you for sticking through to the end as well. The fact that we didn't have, I think we had one caller who came in late and then dropped off. That's a pretty good indication that everybody found your content interesting and was following along with you. Because if they weren't, they probably would have dropped off in the first 10 or 15 minutes, which we've seen that
Right.
before. So everybody stuck with you. That's really good.
Good.
For everybody that's on the call, if you're looking for a PDH, the form is available through registration with SAME. Please email registration@same.org to get a copy of that. If you don't have one available, that is a self-reporting PDH. Please remember that we have a young member call scheduled next week, same time, 12 noon on Thursday the 13th, and that's 12 noon Eastern time. And our next webinar is going to be this fall, and that will be on ethics. So with that, thank you everyone for attending, and thank you very much, Brent.
Yes, not a problem. Thanks for having me. I enjoyed it.